Hey there, everybody. Welcome out to another heavily anticipated virtual workshop. It's good to be with you all again. I'm Scott Durfee. That's Ray Kimbrell. And that's Ben Watson. We'll get these guys introduced here in just a second. But I want to be the first to welcome you out tonight. We've got a lot of great stuff planned for you. As you well know, this is in response to your desire to have more events, especially more advanced events, which we will be doing here tonight. And so you're welcome. We listen to the things that you want, and we do the very best that we can to accommodate when it makes sense. And indeed, this one does. So welcome, everybody. We're glad you're here. We're excited to bring you this to you on behalf of Charles Schwab and our trading division. But before we begin tonight, just a quick note. Everything that you're going to need to know about the event is available through the Event Hub. Now, that Event Hub, you can access that through your email. You receive several emails. I think the most recent one was just maybe several minutes ahead of the event. So just go back into that, find your emails, and the Event Hub may be accessed there. Now you can access that. That'll give you your it's kind of your central spot for the schedule, the speaker info, the downloads. We are recording tonight's session, and it will be available to you there. As well as any support. In fact, that's exactly where, again, that you'll get those recorded sessions, as well as that's where you'll submit questions for Friday's Q&A session, which, just as a reminder, will be at 10:30 a.m. Eastern Time. Yes, 10:30 a.m. Eastern Time. We'd love you to submit all the questions that you have ahead of time so that Ray can compile all those questions together and give us a great experience on Friday morning. So please take advantage of that. You can go in as often as you would like to submit those questions. The only one thing that we will ask is if you ask a question and then you want to expand on that question and don't want the first part erased, then don't erase it. Just add to it. Put a colon or a period and just continuation with the original question. There will be several spots for you to answer the different topics or to ask questions within the different topics as well. Hey, before we get rolling tonight, I want to introduce my good friend there, Mr. Ray Kimbrell. Probably should have done that a little earlier in the thing here, but how you doing, Ray? Introduce yourself to us, will you?
It's great to be here again with everybody. And as Scott said, there's going to be a lot of people in the session today. And so Scott and I will do the best we can to keep up with the chats. But to reiterate what Scott said, if we don't get to your question in the chats, that Q&A session coming up on Friday will be your best bet. So enjoy the night. Enjoy Ben. I know you will. And back to you, Scott.
All right. Let me introduce you, Ben. Have you got a slide I can go through for you there?
Yeah, absolutely. Let me pop back over here and let's go to our.
Thanks for having that up, by the way. And don't hesitate, Ben, as we go through to bring that back up to just reiterate those things that I just talked about. So before I introduce my good friend to you, who will be the main instructor here tonight, the couple of things that we need to go through. Anything that we're going to be doing here tonight will be for educational purposes only. You need to know that options contain certain characteristics and risks that are kind of unique to options. You need to understand what they are. They're not suitable for all traders. So understand that before you go into it. Also know that everything that we're doing tonight will be, again, for educational purposes only. We're not here to give advice in any way, just education. Next slide, Ben.
You got it. Popping right to this next one right there.
There we go. There he is. Ray, as Ray refers to him, there's Mr. Blue Eyes himself. It's good to have you. It's kind of good to be back. It's been a long time since the three of us were together in this setting, and it's kind of fun to be able to do it. But I want to introduce your main instructor tonight. His name is Ben Watson. Ben Watson's been an education coach, as you can see, since 2005. He's the host of Your First Trade on the Schwab Network. I don't know if you're aware, we have a Schwab Network. We'll be talking about that, or at least introduce that to you throughout the course of the workshop here over the next few days. But Ben hosts Your First Trade on that Schwab Network. Very popular and helpful class. It's not really a class, but it kind of is a class, but a show there on the network. He specializes in teaching the Thinkorswim platform. He specializes in teaching technical analysis. He specializes in teaching stocks and option strategies. He specializes in teaching basically anything you want to know. I had a very complex question about a certain option strategy the other day, and I sent it to Ben. He's my go-to guy. So there you go. Ben, Good to be with you again. Without further ado, ladies and gentlemen, let me introduce you and give you my good friend, Mr. Ben Watson. Take it away, bud.
Thank you, Scott, and welcome to all of you, and thank you all for being here. Let me do this really quickly. Let me return the favor and just introduce you to those great support folks and participants and co-instructors in this discussion, as well as when we do this in the live version. Scott Durfee, who you've just heard from. You can follow Scott on X at Scott Durfee CS, but Scott's been an education coach since 2006. You see him regularly on the Schwab Network. Now, remember, Schwab Network is brought to us by our media affiliate, Charles Schwab Media Productions, separate but affiliated company. Also, one of the things that Scott does, he specializes as well in teaching technical analysis, stocks and options strategies, and is a great friend and a phenomenal resource for this webcast. So you've got him out there helping to answer the questions in the chat. Additionally, we've got our good friend Ray Kimbrell. You can follow Ray on X at Ray Kimbrell CS. He's been an education coach longer than either Scott or myself. He's been an education coach since 2004. He is a regular contributor on the Schwab Network, and is a regular contributor, as is Scott, on my show on the Schwab Network. But he also specializes in teaching the Thinkorswim platform, technical analysis, option strategies. He's got some great experience and some great insight into not only this content, but all of the things that we teach. So I'll tell you what, no two better guys that I can think of to have backing me up on this discussion today and helping you to answer the questions along the way. So we certainly appreciate you all being here in this conversation, as well as our great production staff. So let's talk a little bit about where we are headed, and then we're going to jump right into the discussion today. And as, of course, we have to take care of some of these housekeeping ideas and pieces of information before we get into the meat of the content. So I appreciate the understanding in that sense. We're going to talk long vertical spreads today.
Hey, Ben.
And long vertical spreads, really kind of the starting point, if you will, for advanced option strategies, putting together something that many options traders are familiar with, that is the purchase of a long option, and combining that with something that maybe they're not as familiar with, and that is the sale of an option, creating that into a building block that then can be used for other advanced option strategies. And that's how you're going to find this content throughout this discussion starting tonight, is we're going to build on some of the things that you probably already know about. Now, I'm going to say this. There are some of you here that are very advanced and have a good, solid understanding of option strategies and option mechanics and option pricing. There are some of you here that I'm sure are brand new to this discussion. And that's great. We're glad that you're here. We encourage you entirely to stick around and stick with this. For some of you who are brand new, however, there are going to be some things that are going to be pretty advanced. For those of you that have been doing this for a while, there are going to be some nuggets of insight and some nuances that you are going to learn from. So stick with us, and remember to be helpful and kind to one another out there in the chat, and help out so that it takes away from this event something that is beneficial to them. So let's jump into the world of long vertical spreads here in this discussion, and we'll talk generally about the goals for what we're going to talk about tonight in this discussion. And again, I know some of you said, well, wait, are we going to talk about iron condors tonight? Are we going to talk about all of these other things? We're going to build step by step so that we have a clear understanding. So tonight's discussion is focusing on long vertical spreads, how we might choose a particular stock, and how we might view the impacts of the primary forces at work: price, time, and volatility. Those three things are the things that influence really any option trade, and long vertical spreads are no different than that. So we're going to jump into this discussion here, and we're going to talk a little bit about position size. We'll talk about the implications of this changes to price, time, and volatility. And we're going to talk about some practice. We'll put together a number of different strategies as we go along, and a number of different examples using the Thinkorswim desktop software platform here as we jump into this discussion. So,
Ben,
two types of long vertical spreads. Oh,
Ben,
yes?
Ben, I don't think you have your earpiece in. I've been trying to get your attention.
Oh, I'm sorry.
No, all good. All good. And I don't want to interrupt the flow, but there's been a question. I failed to mention this in the beginning, and it's important that we do. Ben's slides are available, everybody. You should download these slides. We call them a reference guide. They're also accessible in the hub, the event hub. Also, that's exactly what I referred to in the beginning. So access that through your email. Sorry for the interruption, Ben.
No worries.
Okay.
And I will show that again when we get into the discussion here. I'll pop out and we'll show some additional resources because there are some great resources. And I noticed some familiar names here in the chat. I also notice a whole lot of new and unfamiliar names, which is phenomenal. We're glad to have you here as we get into this discussion. So we'll show you where those are again. But just a quick reminder, go to the reminder email, go to the event hub. You're going to find those in the resources, and then I'll show you where they are. Plus, we've popped those into the chat right there. So two types of long vertical spreads. Long call vertical, which is bullish, and a long put vertical, which is bearish. That makes sense given the fact that we are driving these two different types of trades with the long option. So if we are buying, because this is a long vertical spread, means we are net debit, we're buying this spread as a whole. When we're long a call, we're bullish. When we're long a call spread, we are bullish. We have a bullish bias on the trade. When we are long a put, we are bearish. So that means that when we are long a put spread, we are bearish in our directional bias. And that's really the structure of these trades to begin with. Now, if you were to put those two together, you're going to see a similar risk profile to something that you might already be familiar with, and that is a condor type spread or an iron condor spread. And so if you start to look at this process, again, this is our objective with both of these types of spreads, either a long put vertical or a long call vertical. Now, we're going to start tonight with this discussion, and I will say this. We're going to spend the majority of our time out on the Thinkorswim platform. I like to teach using the Thinkorswim platform so that we have a clear understanding of how that process works and how you use that platform. We're additionally going to give you some resources, if you are new to the Thinkorswim platform, of how you can begin that process and how you can kind of begin to take advantage of those scenarios and the tools that you have available to you on the Thinkorswim desktop software platform. So from here, here's our objective. Now, I'm going to start actually with a long put vertical spread, meaning we've got a bearish bias. And for no other reason in terms of a long put vertical spread, other than the fact that the long put vertical spread may benefit if implied volatility goes up, as does a long call vertical spread, but there's a greater likelihood that implied volatility is going to rise into the directional movement of a long put vertical spread. So we're going to talk a little bit about that as we get into this structure. So let's pop over to the Thinkorswim desktop software platform, and I'm just going to give you some familiarity with this platform as we get started. So I'm going to start on the monitor tab over here on the left-hand side. That's where you're going to see positions. Then we've got the trade tab, which we will use to be able to see the option chain and the information about our options. We've got the analyze tab, which is something that we will use to help us to visualize the risk and potential return on the spread trades that we create. And I'll explain more about this particular tab as we get into this discussion. I'm going to use the Market Watch tab as a means to help us to see some opportunities. I've got some watch lists already built, and I'm going to show you some resources about how you can build your own watch lists. And then we're going to be using the charts tab. So the charts tab is going to help us to see from a technical analysis perspective and kind of visualize the relationship about what is happening. So before we go any further, I want to take a look really quickly at one particular indicator that might give us some information that might be helpful to these types of trades. Now, long vertical spreads, and I mentioned the movement in volatility, long vertical spreads typically benefit from low and rising implied volatility. Low and rising implied volatility suggests that there is greater demand for those options, or demand for those options is increasing. One of the methods that we use to evaluate where implied volatility is as a market as a whole is the volatility index, or the VIX. And many of you, I'm sure, are familiar with the VIX already as an index. This index right now, if we take a look at where it is, and I want to just kind of get a sense of what our posture is, that VIX is relatively low, but you can see this inclining trend line that I've drawn down here at the bottom of the chart, and I'll just zoom in on that time frame. You can see that generally the VIX is low and has potentially been rising just slightly. Even though it's come back down to that diagonal trend line, it's kind of over time making higher lows. So volatility getting bigger, right? And so as CES says, low VIX is a good time potentially to buy options, either buying a call or buying a put. What did I say at the very beginning of this discussion? Long vertical spreads are driven by the option that we buy, whether we're buying a long call or a long put. Now, normally, when we buy a long call and we see the price of the stock going higher, volatility does not rise that much. Generally, we relate a rise in implied volatility or a rising VIX to either panic in the market or an earnings announcement coming up with the potential for increased volatility or greater movement. So we've got a low and rising VIX. Perfect circumstance generally. Now, it doesn't mean that we're going to have any greater success, but it is generally a good circumstance to have for long vertical spreads. Low and rising volatility benefits long vertical spreads, right? Now, Andrew asks a great question, and I'm glad you asked the question. Why do we use the VIX and not implied volatility? Well, guess what? When we look at individual stocks, we are going to look at implied volatility for those individual stocks. I wanted to set the stage globally for what the market is doing in terms of implied volatility, because that's going to feed back into individual stocks, because this is the implied volatility essentially of the broad market, the cross section of the SPX over a 30-day time frame, right? So that's the reason why we're looking at that scenario here, okay, and using the VIX. So I'm going to pop back over here to my Market Watch tab. I'm going to change my watch list. I've got a couple of pre-built watch lists, and I've got a couple of watch lists that I have built already. I'm going to look for one that is taking advantage of bearish movement, potentially bear flags type of trades. Stocks that have maybe begun to move in a short-term downward direction. Now, I'm going to give you some additional resources so that you can find more information about these particular stocks. I'm going to choose one here that might give us an opportunity to see some of that downward movement, and that is CarMax in this particular case, KMX. And I'm just going to select that, and I'm going to put that over here on my chart. I've got my single grid, and those of you that are familiar with the webcasts that I teach, you know that I use this single grid as, KMX, there we go, CarMax right there. This is a particular grid that I use as kind of a sandbox or a playground, right? So let's take a look at what's going on here with CarMax. We've got low implied volatility. We've got CarMax with a downward move today, kind of sitting at a level of support. And I'm going to add a little bit of room to the downside on this particular chart. So I'm going to come over here to my gear icon, and I'm going to add about 20% of room to the downside of the chart. Not that that's where the stock is going to go, but that gives me a sense of where I can make it look like we can see that downward range here. It makes it easier to work with this particular chart. So let's take a look at, for just a second, at why we might choose or how we might use a long vertical spread here. We might simply buy a long put, but buying a long put is going to be relatively expensive. If we were to go to the trade tab here and we say, look, my expectation is that the price of the stock is going to break that support level and continue to move to the downside. Buying a long put would be one way to take advantage of that. Now, I'm going to click on the trade tab, and I'm going to take a look at these strike prices. So I'm going to go out in this particular case to the 19 September expiration, 60 days to go from now. And we're going to look at these put options, right? And these put options, not terribly expensive, but they are relatively expensive, fairly narrow bid-ask spreads. And if I were to buy, say, for instance, the 62.5 put option here, that's going to be about $3.70. So if I were to extend that out by clicking on confirm and send, that's going to be about $370 for one contract of that put option, expecting the price of the stock to go down. That's going to be sensitive to implied volatility. If implied volatility goes up, that's going to benefit this trade. It's going to be decaying away by the amount of the theta. Each day that goes by, that's going to eat away at that premium, right? Okay. So now that we've got that sense in place, right, now that we know that what our individual option might be priced at, let's talk about the idea of using a long put spread. Now, Kieran asks a great question. We can start from scratch. What's a put and call? Unfortunately, we can't go that far back into the basics, but I'm going to give you some resources about how you can learn that information, right? So to summarize this, I'm looking at buying the at the money strike in this particular case, right? Okay. So the thought process here in putting together, I'm going to go back to my chart, putting together a long vertical spread is I want to buy, so I'm just going to put a little arrow right here pointing out where the price of the stock is, right? So I want to buy the option where the stock is, and I want to sell the option to create my vertical spread where I think the stock is going, okay? Where I think the stock is going. So now the question is, where do I think the stock is going, right? In creating this long vertical spread, where do I think this stock is going to go to? And so now we have to make a decision about that. We can talk a little bit about the nature of price patterns. We can talk about symmetrical moves. That's one way to do it. We might use a range of movement. We have a resistance level here, and we have a support level here. And by the way, if you want to learn more about support and resistance, we've got a great series of webcasts on technical analysis to help us understand that information. And we could look and simply say, look, I've got a range here between about 72 and about 62. So it's about a 10-point range that the price of the stock could move to. So we might look at the price of the stock coming down here to about the 52 level. We might also, however, use the expected move. So let's do this. Let's pop back over to, let me clear my annotations here. Let's pop back over to the trade tab and let's take a look. Now, we don't have a 52 strike. We have a 55 strike and we have a 50 strike. So we don't have anything in between there. We have $5 wide increments between those strikes. But I want to see where that expected move is. So this is an option that expires in 60 days. I'm going to come over to the right-hand side of this option chain, and I've got two numbers here, 34% and plus or minus 6.85, okay? The 34% is implied volatility. The plus or minus number is the expected move that the stock is expected to make in this time frame. So in the next 60 days, the lifespan of this spread, the expected move based on current implied volatility is a $6.85 move, in this case, either up or down. Our expectation, our opinion in this particular case, is that the price of the stock might move down. Again, that's suggested technically. That's not a recommendation. This is simply an illustrative example. So let's put this trade together. We've got the 62.5 strike. If our expected move is $6.85 to the downside, we can even just use the calculator here, right? And we can say, look, 62 half minus $6.85 would put that strike down, or that expected move down, around $55. Not quite all the way down to 52, which is what the technical analysis suggests, but 55 is pretty darn close to this 55 strike, for which, if we were to sell that, we're bringing in $1. Okay, cool. So now what we're going to do, remember the idea is buy where the stock is and sell where we think it's going. Buy where it is, sell where we think it's going. So what we've just done is we've just put this together for the structure of making that move and that expected move. Now, here's the other thing, and a couple of you are asking about, well, what about the duration of this particular trade? This is out 60 days to go into the future, right? And a lot can happen in 60 days, and you're absolutely right. So there's nothing that says that we have to go 60 days out in the future. And if we were to go a shorter period of time, we would change our expectation about how far we thought the stock might move. But since the driver of this trade is a long option, right? The driver of this trade is a long option. By buying a little bit more time, we are taking out of the equation a little bit of that sensitivity to time decay, okay? So we're giving ourselves a little bit more time and expecting that we're going to see a move relatively quickly. We could go shorter period of time if we wanted to, all right? But in this particular case, and with the choices that we're presented with, that's what we're going to look at. So we're going to buy the 62.50, which we've already got selected down here in the bottom, and then we're going to sell the 55. Now we're selling the 55 for $1. We're buying the 60 or the 62.50 for about $3.70. That leaves us with a $2.55 net debit, right? And we're going to say, all right, so we're pretty close to that. We could do that B-Fish, right? Or to RX 225.87. Yeah, you could add that to that, right? Or Luann, I think, was the one that asked that question. But we're using the strike prices here in this particular case. Now, if I click on confirm and send, here's what we've got in this particular trade, right? We now have a maximum theoretical gain in the trade, which is simply the difference between the two strikes, right? 55 minus 62.5. And we subtract from that the cost of the trade, right? The cost of the trade. This is a debit spread. See, yeah, absolutely. You've got that in this particular case. So the debit spread means we're paying for this trade. So the cost of the trade, the amount that we are paying for that, right? The amount that we're paying for this is our theoretical maximum loss in the trade, right? Theoretical maximum loss in the trade. So that's kind of how we're putting this particular trade together, right? So 55 strike, just outside that that expected move, just outside Chris or CHRD, just outside that straddle range, exactly. So our expectation is that the price of the stock is going to make that move to the downside, and if it does, that's the expected potential maximum gain. Now, here's the thing about vertical spreads and about long vertical spreads to begin with. If for some reason that long vertical spread were to end up in the money at expiration, in the money prior to expiration, we could be at or near maximum theoretical gain in the trade. And if that's the case, we could close the trade down prior to expiration. Our ultimate goal is to have both of these legs of this spread, both the 62.5 and the 55 strike. We want both of those legs to end up in the money at or near expiration. That's our desired goal, right? We want this trade to move in that particular direction. Now, here's the thing. This is a trade that is going to require movement. So let's look at this on the Analyze tab here really quickly and just kind of visualize that movement that might have to happen here. So I'm going to right-click, and I'm going to select Analyze Trade. And we're going to put this trade on the Analyze tab, and I'm just going to show simulations. And so here is our Analyze tab, and I'll kind of grab this and stretch it out a little bit. And let me explain this for those of you who are not familiar with this risk profile graph, just really quickly. This axis, the y-axis, is profit and loss. Okay, y-axis is profit and loss. X-axis is the stock price. So the x-axis is the price of the underlying stock. So what this tells us is that our maximum theoretical loss occurs if the price of the stock goes above 62.5. So if this bounces up off of that support level and it continues to move to the upside, maximum theoretical loss in this particular case is that our maximum loss that we saw in the trade, which was, I think, $255, right? And that would occur if both of these legs expired worthless and we lost that value in our long leg that we paid for. Maximum gain on this trade occurs if the price of the stock is at or below 55 at expiration. Cool, right? So that's what we want to have happen. We don't want the price of the stock to go up. We do want the price of the stock to go down. We want the price of the stock to go down below 55. And if it does it fast, great, that's fine. If it does it in 40 days out of that 60 days, that's fine too. If it does it in 55 of those 60 days, that's fine as well, right? So here's the scenario. One of the things that we have to have happen in a trade like this, in a long vertical spread, the way that we've structured this particular example is we want the stock to move. If it doesn't move, then it maybe isn't the trade that we would want to take in that particular case. A long vertical spread is not necessarily a strategy that we would employ when we expect non-directional or neutral movement. We want to see some movement. Just like when we bought a put, we wouldn't expect that that put option would be beneficial if the price of the stock didn't do anything. Same thing with a long put spread. We want the price of the stock to move down, and we've kind of put ourselves in that condition for that scenario to happen here. Now, here's our break-even point, and the break-even point right now is where that line is crossing the zero line. The light blue line that you can see here tracing out that typical long put vertical spread profile, that is at expiration. The purple line is where we are currently today. Now, I want to do this. Now that we've got this in place, I want to show you a little bit about what this trade looks like from a Greek standpoint, from an option Greek standpoint, right? Okay. So we're going to go back to the trade tab and we're going to look at these individual legs, right? And I want to kind of walk through these option Greeks, and then we're going to come back and we're going to talk about how we constructed this and how we might change this, okay? All right, so Daniel asks a great question, and I think this is a good question to answer in this particular case. Daniel says, why is it called a long vertical spread if you're expecting the stock to go down? It's a long vertical spread because we are buying the spread, right? We are buying the spread. When we say long, that means we're buying something, okay? Buy, long, okay? Now, how do I determine the direction in which it'll move? I don't know for sure, right? I have no idea if the price of the stock is going to bounce up tomorrow or if it's going to continue to go down. But I'm using my technical analysis to make an assessment about what I want it to have happen, right? What I want to have happen. Okay, so as we put this trade together, let's take a look at our option Greeks for just a second. I'll grab my magic marker and we're going to kind of go through these Greeks here really quickly. We've got delta, theta, and vega, price, time, and volatility, right? So delta is our price sensitivity. Theta is our time sensitivity. Vega is our volatility sensitivity. So the long leg, the one that we're buying, has a delta sensitivity of about 51 cents, which means that if the price goes down by $1, that option premium should go up by about 50 cents or 51 cents, okay? Now, the short leg, in this particular case, the 55 strike, has a delta of about 19 cents, but we're selling that premium, right? So if we grab our calculator over here on the other side, we've got a 51 cent delta, and we subtract from that a 19 cent delta. So we're left with about a 32 delta. So this is directionally sensitive. It's not as directionally sensitive as the at the money long put, but it is still directionally sensitive, right? It is still directionally sensitive. Still benefits if the price of the stock goes down, okay? So let's keep that open. Let's come back over here. I'll clear those annotations really quickly, and we'll take a look at the next one, which is theta. So notice something here. 62.5 has a minus 2 cent theta. The 55 strike has a 2 cent theta. Those two wash themselves out, right? Those two wash themselves out, which means going 60 days out from expiration, this trade does not suffer, at least as it stands right now, does not suffer from time decay. It is a wash based on the net theta between those two strikes. So that net theta on those two strikes is 0. So it doesn't matter if time passes. Doesn't matter if we've got a little bit of time left to go until expiration, 60 days. So to go back to answer that question, theta is our sensitivity to time. Time is always passing in one particular direction, as in the musical Annie, the sun will come up tomorrow. We know that barring any certain existential crises, tomorrow the sun's going to come out. Time is going to pass, and it's always passing in one direction. That's always eating away at our long option. It's always helping our short option. And the net sensitivity to this option in terms of time decay is 0. So that's nice because we're buying a little bit more time to let the stock move. That's helpful. It isn't always that case. So let's look at our next sensitivity, and that is implied volatility. So here's implied volatility for our long leg. Here's the implied volatility for our short leg. That means if implied volatility goes up by 1%, right? If implied volatility goes up by 1%, our long leg is going to gain about 10 cents of premium per 1% of implied volatility increase. But it also means that our short leg is going to gain about 7 cents, and that's working against us because we want that short leg to get as cheap as possible, as quickly as possible. Okay? All right. So if we look at the 62.50 strike and we look at the 55 strike, we're left with about 3 cents positive Vega or positive volatility sensitivity, right? Positive volatility sensitivity. So if Vega is positive 3 cents for this spread and implied volatility goes up because it's low and has the potential to rise, and if the price of the stock goes down, guess what's likely to happen to implied volatility? It's likely to go up. That is beneficial for our trade. So here's what we're left with at this particular point. We are left with a spread that is directionally sensitive to the downside. Benefits if the price of the stock goes down. Doesn't matter if time passes or not. We know time is going to pass. And number 3, benefits if implied volatility goes up. Benefits if implied volatility goes up. So those are our 3 influences on our option trade: price, time, and volatility. So let's go back to let's close down our annotations here really quickly. Let's go back to our chart and let's take a look at what our expectations are. Now, implied volatility, because I've got that on the chart, right? Implied volatility is low and potentially starting to rise, right? And potentially starting to rise. And as we have a directional movement below that level of support, if that moves, we don't know for sure that it will, but if this moves to the downside, our expected move based on implied volatility is down here to that 55 strike. So this is where we're expecting the stock to go, to right here. And if the price of the stock does make that move, here's what's going to happen. The value of this long put spread is going to increase. The value of this long put spread is going to increase, theoretically. That's what we want to have happen. Because if we take a look at what we're doing here with this trade, we pop open our order entry from the bottom. We're buying this spread for $2.55, and we want this trade to go up. We want this trade, we want the price of this option to increase. We want to buy it when it's cheap, sell it when it is expensive. Now, the most that spread would be worth is going to be the width of the strikes minus the premium. That's maximum theoretical gain. Because if I click on confirm and send, we see that, again, our maximum theoretical gain in this trade is $4.95 times 100 shares, or $495, right? Maximum loss in the trade, $2.55 per share times 100 shares, or $255 in trade, right? That's going to be the theoretical maximum loss in the trade, is the cost of the trade, right? All right. So now that we've kind of put that trade together and we have a sense of what that trade is expected to do, let me answer some of the kind of ephemera questions that are coming in through the discussion really quickly. Okay. So there's a question from Treasury Guy about volume and open interest and the liquidity of these options. So let's kind of answer that particular question as we go into this discussion. Let me clear that annotation, and I'm going to come back over here, and we're going to take a look at our trade tab to get that information. So I'm going to go to the trade tab, and we're going to take a look at our option chain. Now, on the option chain here on the Thinkorswim desktop software platform, I can change my layout on this option chain to show volume and open interest. Now, here's what I notice, that my 6250 strike had a volume today, trading volume today of 75 contracts. My 55 strike had a trading volume today of 18 contracts, right? And I've got 1,013 contracts of open interest on the 62 half, and I have the 55 strike has 200 contracts of open interest, right? So that tells me something. That tells me that this is a relatively liquid market, right? This is a relatively liquid market. This is a stock that trades 2.9 million shares average daily volume of the stock. This tells me that there are 200 contracts out there open and unexercised, and 1,013 contracts on the long side open and unexercised. This is not an illiquid market, right? So in this particular case, if we were to trade one or two contracts of this spread, we are still well below that open interest number. We're not a big fish in a small pond. We want to be a small fish in a big pond. We want to be a small fish in a big pond. So if we were going to trade 50 or 100 contracts of this vertical spread, this long vertical spread, then we might have some concerns, because then we're about half of the open interest of that 55 strike, but we're not. So if we're trading one or two contracts, we're just fine in terms of that liquidity. Now, we're going to combine that look of volume and open interest with the width of the bid-ask spread in between the bid and the ask on both the long side and the short side. So we've got about a 10-cent wide bid-ask spread on the short side, and we've got about a 20-cent wide bid-ask spread on the long side, and I'm perfectly comfortable with those amounts. In fact, I'm not going to tell you. I know a number of people are saying, well, it's got to be 10% of the width of the strikes, or it's got to be 10% of. It doesn't. It's got to be a narrow bid-ask spread relative to other bid-ask spreads. So here's a couple of other things to think about, and a couple of other questions to ask. Kenneth asks a follow-up. How low can volume and open interest be? If you have one contract or two contracts in open interest, that's probably an illiquid spread, and you're going to see a wider bid-ask spread. In fact, you can see that down here, right? You can see that if we go deeper in the money to the 77 half strike, that's got a 1610 ask and a 1550 bid. That's a much wider bid-ask spread, right? So we want to be narrow relative to other strike prices within the same range. Now, a couple of things that we've been thinking about as we put this idea together, right? That this is an expected move. Now, do we have to trade it this way? Could we be more aggressive in how we put this trade together, right? Okay, yeah, and Babu, yeah, open interest, be a small fish in a big pond, right? Small fish in a big pond. There's not a required liquidity. Just feel comfortable with being a small fish in a big pond. All right, so could we put, so LA, you know what, here's the thing. This is a liquid stock. That's not an illiquid contract size, right? Number of contracts, not illiquid, especially when you've got a 10-cent wide bid-ask spread, okay? All right, so let's go back to that chart and let's say, all right, what if we wanted to be a little more aggressive in how we take this trade, right? In terms of the possibility of stock price movement, okay? Could we create a trade that is a little bit more aggressive? Yeah, we certainly could. So let's go back to our trade tab. So if we expected that the price of the stock was going to make a big move and make it very, very quickly, we could create this trade more aggressively. This is kind of the baseline, if you will. But let's go back here to the trade tab and let's say, you know what? I'm going to go a little bit further out. I'm going to go to the out of the money, just the out of the money strike. We're going to go to the 60 strike, right? And you notice that that has a 10-cent wide bid-ask spread as well. 732 contracts, 18 contracts in volume. That's fine. Nothing wrong with that. But we're going to, instead of buying the 62.5, we're going to buy the 60 strike. So I'm going to buy the 60 strike, and we're going to pay $2.55 for it. But we don't have any extrinsic value there. That's all, or in any intrinsic value there, that's all extrinsic value, right? Okay. So now what we're going to do, and by the way, your mileage is going to vary when it comes to volume and open interest. But now what we're going to look at is we're going to buy that 60 strike, and we're going to look at maybe selling maybe a little bit more aggressively, right? So I'm going to sell maybe out to the 50 strike. So now we've got a $10 wide vertical spread. So I'm going to go to the 50 strike, and we're going to sell the 50 strike. So now our net debit is 205 against a $10 wide vertical spread, right? So I'm going to click on confirm and send, and we're going to look and see what our profit and loss potential is here. Profit and loss, max theoretical loss, 205, paying less for the spread because we're paying less for the long leg. And our gain is higher because it's costing us less to get into the trade, even though we're getting less premium to offset the cost of that long leg. So max theoretical gain in this trade, $7.95 times 100 shares. Max loss, 205. Smaller cost to get in the trade. The difference, however, in this particular case is the probability of success. The stock has to move further to be able to give us that maximum theoretical gain. Because in order to get a maximum theoretical gain in this particular case, the price of the stock has to be, in this case, at or below 50 at expiration. You notice what also changes is our break even, right? Our break even changes. So John asks a great question. Why are profits and losses theoretical? Because news changes everything. Implied volatility might change. And these are theoretical because there's no guarantee until we actually close that trade down, John. That's why we call them theoretical in this particular case. Okay? All right. So let's kind of look at one other way that we might create this particular trade. Oh, by the way, let's do this really quick. Let's throw this on the Analyze tab. Let's take our first one off, and let's kind of squish this back in here again. There's our max loss at 60. Here's our max gain here at 50. And we've got a smaller potential loss. We've got a larger potential gain, but the stock's got to move further in order for us to get to that point. Stock's got to move further in order for us to get to that point. So the probability of success in this trade is lower, a little more aggressive. A little more aggressive means that that probability is less. It's got to go down even further than where we projected it to move. Now, let's go a little bit less aggressive and see how we might put this particular trade together. So now what we might do, let's come back to the trade tab. Stock's already sitting at this 61.47 level. Let's go back to the trade tab and let's put together a little bit less aggressive trade. The stock doesn't have to move quite as far in order to get us to what we want it to do. So we might go to the 65 strike, right? And we might buy the 65 strike. We might even buy the 67.5. But in this particular case, I'm going to buy the 65 strike, okay? A little bit further in the money. Higher delta, in fact, if we change our layout once again back to delta, theta, and vega, the 65 strike has a lot higher delta, got a 10 or 12 cent higher delta than the 62 half. It's going to cost more. So if we buy the 62 half, $5.20, but then we sell, let's say the 60 strike, stock doesn't have to move very far in order to get there. So we're still at the same net debit as our first trade that we put together, but it's a smaller spread. Let's do a confirm and send here. Now we're roughly balanced in terms of profit and potential loss. So theoretical gain in the trade, 245. Theoretical loss in the trade, 255, right? 255. So a little bit higher maximum loss, a little bit lower potential gain, much higher probability of success, right? Much higher probability of success. Now, William asks a great question. We're sitting at support. Why are we going into a bearish trade? Well, we might trigger this trade on a conditional breakdown through support. But to be fair, it was a pretty good up day in the market today. And so there were a limited number of trades that were moving in the downward direction. But that is the expectation here, and the overall trend is still to the downside. This is roughly, to Frank's point, roughly 1-to-1 risk to reward in this particular case, right? Okay. Now, Gina asks a great question. Isn't it a big risk to have the short leg go in the money? You could be assigned. Yes, you could. You could potentially be assigned on this, in this particular case, the 65 strike. But you know what? Here's the cool thing. If you were assigned early on this long vertical spread, meaning you had to take possession of the stock, guess what? You had to take possession of the stock at that 60 strike, that short strike. Guess what you have the right to do as long as this trade is still prior to expiration? You have the right to exercise your long leg and sell the stock at 65. So having to buy the stock at 60 and having the right to turn around and sell it at 65, guess what? We're just at maximum theoretical gain. So early assignment on a long vertical spread, to Babu's point, assigned early, you say thank you and do it to me again. Baby, hit me one more time with that, right? Because that puts us into our theoretical maximum gain. And if that happens fast, great, that's even better. You exercise the long leg and you take that maximum theoretical gain in the trade. Doesn't always happen, but it can. And so that takes away some of that fear. That takes away some of that fear of potentially being assigned early in a trade like this. So that's kind of the scenario in terms of how we set this this trade up. All right, so let's do this really quickly. Now that we've kind of spent a little bit of time with this bearish trade, right? This bearish put spread and the expectation of the price of the stock going down, I want to kind of take a little bit of a half step here, just very quickly. And I want to talk about some of the resources because I know we've got a lot of questions. I don't want to lose anybody here. Ray and Scott, I know we've got a lot of questions that are rolling in about what about the basics of these strategies? What about the basics of options and those types of things, right? Maybe we ought to take just a minute really quickly before we get into long call spreads and talk about where traders can go, where attendees can go to find more resources. What do you think? Okay, I'm getting the thumbs up from these guys. So you know what I'm going to do? I'm going to pop over here really quickly to a couple of different places. And some of you are familiar with this, right? Some of you are familiar with this. And in fact, you don't have to raise your hand, but I'm just going to ask how many of you have been watching or are watching or would like to watch our trading webcasts, our ongoing live webcasts on our Trader Talks webcast page on YouTube. This is a great educational resource, right? This is where you can go and find 30 hours plus of content every single week, taught with real examples, taught on the platform using the market moving every day. Jay Richardson says, yeah, watch every day. Richard, every day, regularly, right? Cool. Okay. So let's talk about this. This is a great place to go. At Trader Talks Webcasts on the YouTube channel. Love to have you go join us here. When you do, click on that subscribe button so that you can stay connected. But there's one other resource that I want to show you as well. And this is the way to where to go if you want to learn more. So if you wanted to learn more about the difference between, I'm going to give a resource because I know a couple of people were asking, well, why would I choose a long vertical spread versus a short vertical spread? Let me show you. If you go right here and you type in long vertical, short vertical, here you go. Here's Barb Armstrong. When to trade a long vertical versus a short vertical. 3 trades, comparing a long put, long vertical, and short vertical. Planning when and how to take profits early. Long verticals versus short verticals. Comparing a long vertical and a short put vertical. Comparing long vertical and a short put vertical. Ways to structure a short put vertical. Ways to structure long verticals. Long verticals, the basics.
Hey, Keith,
You've got
if you can hear me,
tons
put
of
me on
resources.
screen,
Hey, go
please.
ahead, Scott. Sorry. You were saying something, guys?
Hey, yeah, Ben, actually, I was. Gang, there's been a lot of questions being asked in the chats around these basic option questions. I love the excitement and the exuberance that you have by coming to an advanced class, but maybe sometimes maybe, and you do your own self-assessment to see if this applies or not, but maybe we're trying to put the cart before the horse, some of us. So let's make sure that we have a good foundational basic handle on these basic option strategies. And Ben, if I might say so, and I think you would probably agree, that one series from Barb Armstrong is a very, very good place to start. We'll see if we can get that link dropped in the chats, Ben.
Yeah, I just put the link to the Trader Talks webcast in there, and you can find them right there.
I see that now.
Yeah,
yep,
absolutely. And then the other place you can go, and I'm not going to take too long to explain this because many of you have seen this, but I just want to show you this. Schwab.com/coaching. That's where you can find the schedule of live webcasts as well as upcoming virtual workshops like this one. And then our in-person events. Some of you have been with us for our in-person events. Here's our calendar of in-person events as well. So that's schwab.com/coaching. So those are some additional resources and great ways that you can keep going with this stuff. All right, let's do this. Let's pop back over here to the Thinkorswim platform. And we're going to go back to the charts tab. And we're going to jump into this discussion. Now we're going to put this into the discussion of why we would maybe choose a long call vertical spread. All right. So let's talk about a long call vertical spread. And I had a potential here. So let's go back to CCL. This is Carnival Corporation, right? Carnival is just past their earnings announcement. You notice where implied volatility is. Implied volatility is low and has the potential to rise, right? Low implied volatility, potential to rise, okay? What's the price of the stock doing? Well, it's continuing to make that move to the upside. It's running into a level of resistance. This is a little bit of a potential breakout trade, a little bit of a bull flag. Richard, yeah, we're going to talk about exits in here in just a minute in terms of getting out of these trades before we go. So don't worry about that. We will get to those exits in this scenario, right? Okay, so let's pop over here. I'm going to actually change my chart again. I'm going to go to that little gear icon up here. Now you can drag this scale on the right-hand side, but that also shrinks and grows your candlesticks. I'm just going to add a little bit of space to the upside in this particular case. I'm going to take that space away from the downside. Now I've got that little bit of space here to the upside. So I've got this bull flag. I'm going to take my projected move. A lot of different ways that we can do that, but I'm just going to take this from a technical analysis perspective and say, look, based on this potential move, I can see this stock moving up to about 35 from where it is now. It's currently sitting at about $29.79 or about $30. And a $35 move move to 35 is going to be about a $5 move to the upside, right? Okay. All right. So let's take a look at how this trade might move. So low applied volatility, directional expectation, bullish to the upside. So let's go to the trade tab here for Carnival. And one other thing I'm going to point out here in this particular case, when we measure implied volatility, right? When we looked at the VIX was relatively low. When we looked at implied volatility on the chart was relatively low. But how do we know how low that is, right? Okay. So here's what we're going to do. We're going to use this information right here in today's option statistics at the bottom corner of our option chain. I'm going to scroll down. I'm going to open that up. And what I'm looking for is this number right here, current implied volatility percentile. Because what that tells me is where implied volatility is relative to where it has been. So the highest that implied volatility has been for Carnival is 92%. The lowest that it's been in the last year was 35%. Where it currently sits right now at 36% puts it in the second percentile, right? Very, very low. And when implied volatility is very low, it has a tendency to rise. And when implied volatility rises, that benefits our long vertical spreads. When implied volatility falls, that benefits short vertical spreads. That might be your first deciding factor, deciding to choose a long vertical spread versus a short vertical spread is where is implied volatility. Implied volatility very low, we might think about doing long vertical spreads instead of short vertical spreads. So now let's put this trade together and our expectations once again. So in this particular case, I might go out a little bit shorter period of time in this particular case. It's fine. I'm presented with more choices here in terms of those weekly options than I had available to me on CarMax. That's fine. So I'm going to choose, in this particular case, I'm in fact going to go a little bit shorter. I'm going to go to the 15 August spread here, or expiration. That's 25 days to go until expiration. Now, you know what I'm going to do? I'm going to come over to the right-hand side, and I'm going to say that 15 August implied volatility expects about a $2.50 move to the upside. That's about half of what my expected move was based on the technical analysis. So if technical analysis bears itself out, that's going to take it beyond that expected move. And if I use that $2.50 expected move to locate my strikes, then I'm putting myself into a higher probability scenario. So I'm using technical analysis to increase the probability of success in this particular trade. So here's what we're going to do. We're going to go down here to 15 August. We're going to open that up. Now we are looking at the call side. Remember, we're bullish on this particular trade. So let's take it from that perspective again, starting with the idea, starting with buying the option where the stock is now and selling where we think it's going to go. Buying it where it is now, selling where we think it's going to go. So we're going to buy the 29.5. And you notice that it is a fairly narrow bid-ask spread. Let's just double check really quickly. Volume and open interest. That 29.5 has about 4 contracts, or actually has 0 contracts in this place. So you know what I might do? I might go up a contract in terms of the strike price here. I might go to the 30, or I might go to the 29. And in fact, this case, I'm going to go to the 29, which is going to have a little bit of intrinsic value. It's going to be a little bit in the money, but it's got much greater volume and open interest, right? That's where we might choose one or the other. I'm going to change from that to back to Delta Theta Vega in my layout. I'm going to choose the 29 strike. We're going to buy the 29 strike, 4-cent wide bid ask spread, which is better than about a 10-cent wide bid ask spread. So we're going to buy the 29 strike. Now, if we were to just stop right there, time decay is going to hurt this trade, right, to the tune of about 2 cents a day. We're going to mitigate that out of this equation. So we're going to make this a time insensitive trade. So we're going to buy this option, and at the same time, we're going to sell where we think the stock is going to go, which we said was about $2.50 to the upside. So 29, so about the 31.5. Maybe we even go to the 31, right? That's about $2. Let's go to the 31.5. We could even go out to the 32. Let's see what the volume and open interest is on the 31.5. So once again, we'll change our layout to volume and open interest. The 31.5 has no open interest. So I'm going to back that off a little bit. We'll make it a narrower spread, and we'll get more open interest. We can even go out a little bit further to the 32. I'm going to come back in a little bit. I'm going to make it a little bit softer in terms of that trade, just in terms of what my expected move is. So buying the 29, and we're going to sell the 31. And our net cost on this spread, on that $2 wide debit spread, right, is 96 cents. So that means if I right click or click on confirm and send here, my maximum theoretical profit on the trade, $1.04, maximum theoretical loss, 96 cents, or times 100 shares, $104, $96. About that 1-to-1, a little bit better than 1-to-1 in this particular case. And the stock doesn't have to move even as far as the implied volatility expects it to move. Now, I could make it, Georgian, I could make this even a little bit more aggressive and expect a greater move, but the trade's going to cost me a little bit more. Let's do that real quick. Now that you know how we do this, let's do that. Let's buy the 29 strike, and let's sell that 32 strike, which also had pretty good open interest. The trade's going to cost us more. Now $1.21 against the previous one that was about 95 cents. But look at our potential. Our maximum gain goes up a little bit, not much. Maximum loss goes up a little bit more. Now, this trade, perhaps, as we kind of go through this scenario here, in choosing which one of these that we might choose, this requires a little bit more stock price movement. The break even is a little bit higher. We need to see the stock move a little bit further. So if you have an expectation that the price of the stock is going to move more, you might be able to be a little bit more aggressive. Now let's send this to the Analyze tab. We're going to right click on it. We're going to send it to the Analyze tab. Let me take some of those other trades off. Here's our vertical spread, right? And this is where we can kind of play that hypothetical game. I'm going to kind of spread this out. And I'm going to say, all right, fine. So here's where we are, 15 August. I'm going to expand my likely range to that range right here. And you can see that this is the one standard deviation range that the price of the stock might move in between now and that expiration date. And you can see that my maximum theoretical gain here at the 32 strike is well within that probable range of success. This is a highly probable trade, right? It's going to cost $1.21. If I wanted to change this a little bit, I can widen this spread out, or I can narrow this spread. So if I wanted to widen the spread out and see what that would look like if I were to sell, for instance, the 33 strike, now my net debit is going to be higher. You can see that it's got to come right to the edge of that one standard deviation range. But what changes is my maximum theoretical gain on the trade, because I've made the spread wider, right? I've made the spread wider. If I were to make this narrower, go back to the 32 strike, right? Or we could even make it even narrower than that. We could come back to the 31 strike. Now we've got that $2 wide, once again, 96 cents, and you can see where that spread falls. The Analyze tab gives us the ability to kind of play that what-if game to see where that trade might fall, and we've put this trade together. Now here's something to think about, right? Because I know a number of you are asking the question, well, wait a second. Are we going to put a stop on this? What kind of order or what kind of exit are we going to put on this trade, right? In terms of getting out of the trade. So here's what we could do. If we put this particular trade together, right? We click on confirm and send, and we read through this order, and I might put this in my long vertical spreads group, and I say, look, fine. I'm going to get into the trade. I want to pay for the trade about $1.21, and the most that it could theoretically be worth is $1.79, or that's our maximum theoretical gain on the trade. Would we put a stop order on this trade, right? Would we put a stop order on this trade? The answer is no, because here's what can happen. The price of these options can move around a lot, right? Now, Cynthia, this is a little bit different than if we were putting on a long call option in this particular case. I'm not going to put a stop on this trade because it's already risk defined. I've already risk defined my trade, in this case, to $1.21 or $121. If I want to risk less than that, you know what I'll do? I will adjust the size of the spread, the width of the spread, or the location of the spread to decrease the amount of risk in the trade so that I'm not putting a stop on this trade. But what I could do is I could put the target of what I want to take this trade off at, right? So what I might say is, look, I know that my maximum theoretical gain on this trade is $179 or $1.79. What if I were to take the trade off at, say, for instance, 50% of that maximum theoretical gain? And that way, if the price of the stock were to move quickly, I might take that trade off and then be able to redeploy this capital someplace else to realize another potential gain. So if I take that 179, and I'm just going to come over here to the left-hand side. So I'm going to go back to edit, and I'm going to say, let's come over here to the left-hand side, and let's say $1.79, and we're going to divide that by 2, and I'm going to say, all right, fine. Let's see if we can get this for 89 cents more than what we paid for it. So we gain 90, let's say, we'll call it 90 cents just for easy math. So what I'm going to do is I'm going to now change this from a single order to a first triggers sequential. And I'm going to add an opposite order to get out of the trade. And I'm going to say, fine, on a limit order, which says sell this trade for this price or better, if I can get out of the trade for $1.21, so let's just do this, $1.21 plus, not times, $1.21 plus 90 cents. If I can get out of the trade for $2.11, sell it for $2.11. So I'm going to make this manually $2.11, and I'm going to make that good till canceled. And now what I've built is I've got an order to get into the trade, and I've got an order to get out of the trade if it goes in my direction and I'm able to pick up about 50% of the maximum theoretical gain in the trade. So I don't have to hold on to the trade all the way through expiration. I don't have to hold on to the trade till it gets to maximum theoretical gain. Frank says if you get that 50% profit, take it, right? We're going to use this concept a lot, and so we're going to keep repeating this as we go through the other conversations that we have throughout this advanced options workshop, right? Now, one of the things to think about, you click on confirm and send here, you've got to keep in mind transaction costs. So those transaction costs may be different for different people. So keep that in mind. But if we could take this trade off for 50% or 60% or 80% of that maximum theoretical gain, great, not a problem, right? We take that trade off. I like that, Lily. Always be closing. Always look to close the trade down when it's done the majority of the trade. So William asked the question, how do I get $2.11 when the max is $1.79? The max gain is $1.79. The max theoretical or the max price for the spread is going to be different than that. So we're going to take the trade off at $2.11, right? Now, if you want to sell it, if it goes under the 91 cents, well, you could theoretically put a stop there, but the risk in putting a stop on this trade, right? The risk in putting a stop on this trade is that you get kicked out of the trade on a day when the price of the stock maybe moves down and then turns around and goes right back up, right? go down and go all the way back up, right? Now, we could put this under as a bracket order. Let me show you how we would do that. We'll click on delete. We'll come back to our trade tab, and I'll show you how we can build this. I'm going to change my spread. This is, as we were building this trade, we were at the 29 strike and then the 31 strike. So that is, in this case, 1, 2, 3, 4 strike prices. What I'm going to do is I'm going to come up and I'm going to change my spread to deep and wide, 1 month, 4 strike vertical spread. So there's our 29.31 vertical spread. I'm going to buy it for $1. But what I'm going to do is I'm going to right click and I'm going to buy custom with, we could do a buy custom with OCO bracket, right? Buy custom with OCO bracket, which would give us that limit price to get out if it got to 211, and we would make that good till canceled. And if we wanted to put a stop on here, we could put a stop on here. In most cases, we're not going to put a stop price on there. The stop order is a stop order. The take profit order is a limit order. And in this case, we're stopping out at $1 below our entry price into the trade. And then we would click on confirm and send. You would read through the order and put that order on. But in most cases, we're not going to put a stop order on a spread because it is already risk defined. So it already tells us how much theoretically that trade is set to potentially lose if it goes against us, right? And the way that we would lose in this particular trade, remember, we go back to our Analyze tab, is if the price of the stock in this particular case were to go below $29 a share. And if price of the stock goes below $29 a share, now both of those legs are out of the money. And if we held it to expiration, both of those legs would go to zero at expiration, right? If the price of the stock were below 29, both of those legs would be zero at expiration. We would lose our investment in the trade. So that's kind of what we have to kind of keep in mind here in this structure. And that's how we would put that long vertical spread together. Low implied volatility rising benefits this trade. The passage of time doesn't hurt this trade because if we go back to our trade tab, let's take a look at our net option Greeks. Let's go to our 29.31 strike. 31 cents of delta remaining, so net directionally positive, no theta exposure, and in this case, really no vega exposure right now, although that may change as we get closer to expiration. Now, could we choose to do this spread a little bit further out in time? Absolutely. Let's go out to 60 days to go until expiration. Here's our 29.33. Now, that moves a little bit because we've got more, or actually less strike prices available here. So we could change this and we could go to a deep and wide 1 month. Let's go to 1 month, 2 strike vertical. And there's our 29.31. We go out a little bit further in time and we buy that. And there's our longer to go until expiration, which means simply the stock has more time to move, but it also has more time to move against us. And if we were to look at that 29.31, again, 19-cent directional sensitivity, lower net delta, and the theta and vega are still zero. So we've taken time out of the equation, we've taken implied volatility out of the equation, and we've got a directionally sensitive trade. Now, let's talk really quickly about candidates for this particular strategy. Let's go back to the chart and take a look at this, right? So one of the things that that I wanted to look at in putting these particular examples together is the expectation. So the first thing to think about is this carnival trade has an upward trend. This is a directional trade, right? This is a directional trade. It expects price movement. It doesn't benefit as much, if at all, with neutral movement, whereas a short vertical spread can potentially benefit if the price of the stock doesn't do anything at all, right? Because it benefits from the passage of time and decay of implied volatility. This particular trade expects directional price movement. So in choosing a candidate for a long vertical spread, either a long call vertical like this one, you want to have some directional potential. This is a trade that is moving higher. It's got a pattern, this kind of bull flag pattern or cup and handle, whatever kind of expectation you want to see, but it is at a level of resistance with the potential to move higher. Now, does that mean it's going to move higher? It doesn't. You could also take a trade that is already broken out of a resistance level in this particular case, or broken down through a support level. But I have a bullish expectation, and that's going to be my biggest selection component. Fundamentally, I don't care about the stock. I care primarily about direction. The second question is, where is implied volatility, right? Direction and then implied volatility in the trade. So if we close those annotations and we go back to our previous choice, KMX, the reason I chose this particular trade, I'll grab my magic marker one more time. The directional expectation is down. Yeah, it's sitting at a level of support, but it's been in a downtrend, and implied volatility is low. Okay. So in this particular case, we've got directional expectations as our primary drivers into these trades, right? Now, a couple of people are asking the question, well, what about the story in the stock, right? What about KMX versus Carvana, or what about Carnival versus the summertime, whatever it might be, right? Do this. Cross out or put your finger over the name of the stock in the chart and focus primarily on the directional expectations and the technical analysis. That can help you to make an assessment about what you think the stock might do. All right? So that being said, as we put this trade together, or as we put these two different types of trades together, lots of different ways. Again, lots of different ways that you can use these long vertical spreads. We've looked at 3 different ways to put on that long vertical put spread. We looked at 2 different ways that we could put on that long vertical call spread, more aggressive, less aggressive. We've talked about different time frames. We've talked about the sensitivity to the primary forces at work, implied volatility, time decay, and the big one, which is directional price movement, right? Directional price movement. Direction is going to be the biggest of these, right? In terms of moving the stock. And again, I'm just going to reiterate it one more time. All of these trades expect directional movement. So to go back to Lobsterman's question, which is both of these examples were for breakouts, could you use these for reversals? Yeah, because you know what? Here's the thing to think about. If you had an expectation that CarMax was going to bounce up off of that support level, could you create a long call vertical spread with implied volatility being low? Sure you could. Absolutely. I want you to always be thinking about this if this, then that kind of mindset, right? If this price were to bounce up, then maybe a long call vertical spread. If price were to break down, then a long put vertical spread, right? That's how you project what your directional expectation is into a particular type of spread, right? Into a particular type of trade. I know we're coming down to time here. This time goes very, very quickly, but we've got a couple of things that we want to do as we get into the end of this discussion. So I just wanted to reiterate that, and I wanted to come back over here really quickly to our hub, and then I'm going to come back to one slide that I'm going to pop up for you. So let's go back to the event hub, guys. Ray and Scott, let's talk a little bit about this event hub one more time.
Sounds like a plan. So, by the way, Ben.
Yeah.
Nice job, my friend.
Thank you.
And so a lot of great comments there as well as we saw through there. So we appreciate everybody for hanging in there and staying with us. So the event hub here, the link is in your emails you got going on through there. And what you can do in the event hub is submit, and I know Scott's been dropping a link, submit your questions for the Friday Q&A session. You have to do it in the event hub. All right. That's how you put them in there. And then I get the lucky task of collating all of those. And so do that for us. We'll do it by topic. Okay, it'll go by topic. You'll see that when you get in the event hub and submit the questions. And so just do that for us. Keep them short and sweet. As we'll actually try to copy that question into the chat on Friday, so you can see what's going on. And we'll put Ben on the hot seat for an hour there, and he'll be ripping through those questions. And so take advantage of that. Tomorrow, Iron Condors. And on the reference guide, by the way, some of you noticed on the reference guide that the Iron Condors are actually first on the reference guide, and you'll see the long vertical slides starting around slide 27.
Yep.
So that's how you'll see that. It's nothing wrong with it. It's just in reverse order because it makes more sense to teach it this way. And this is how you're going to go back and forth to get in touch with us and get those things through. Scott and I tried the best we could on answering questions in the chats as they went along, but there's a whole lot of y'all and only two of us. So be patient with us. Get those questions into the event hub. Scott Durfee, how about you, my friend?
Yeah, we got it. Hey, gang, a couple of other things, too, that I just may mention quickly. Make sure you fill out the survey tonight. Make sure that you're putting in those questions for that Q&A. However, a lot of you, or I should say additionally, rather, several of you have mentioned that you just joined us. You came in a little late. Is this recorded? This hasn't been the case in the past, but for this event, we are recording these. Those recordings are also available in that event hub. So make sure you take advantage of that as well.
So I want to do this really quickly, guys. I want to pop this up. We're going to be in Chicago in a couple of weeks. The 15th and 16th, we're going to be talking about technical analysis and option strategies. We're going to be in Washington, D.C. In September talking about technical analysis and option strategies. And then we're going to be in Dallas on September 20th doing a market drive event, which is a one-day event. That's a great event to be able to learn a little bit about all of the things that Schwab does in terms of the resources that we provide. And then the other thing I wanted to talk about really quickly before we jump into this, before we jump out of our discussion tonight, is this. Whoops, let me grab this slide right there. I was one slide behind. Let's come back to this one. There it is right there. If you want to learn more about the Thinkorswim platform, right? If you want to learn more about the Thinkorswim platform, this is a great way to do this. This is our trading solutions, folks. They can set up a 45-minute one-on-one walkthrough with you to be able to set up your Thinkorswim platform, to learn more about the platform, to make it work the best that it can move for you and that it can work for you. There's the URL. There's the QR code. Make sure that you sign up for that, and that is available once every 6 months. And it can help you to customize the platform to work the best way that you can get that platform to work. So there you go, Cynthia. That answers your particular question as well. Guys, also fill out that feedback survey. Remember also that you can follow me, you can follow Ray, you can follow Scott on X at Ben Watson CS, at Ray Kimbrell CS, at Scott Durfee CS. And tomorrow night, guys, we're going to talk about Iron Condors, as you mentioned. We're going to be back same time, same channel, right?
We are. And so make sure you come back into class and see us. Looking forward to having you there. And have a great evening.
Very cool. Hey, we'll see you all tomorrow night. Have a great night,
Thanks,
everybody.
guys. Yep, take care.